If you're just noticing silver right now, you're already late, and that matters. Not because of the price on the screen, but because of what just failed underneath the market. This wasn't a rally. It was the release of pressure that had been artificially held in place for months. For a long time, silver appeared calm. Every push higher was quietly absorbed. Every attempt to break out was met with invisible resistance. To most observers, it looked like a market going nowhere. Controlled, predictable. But markets that look controlled for too long usually are. What you're witnessing now is not a normal fluctuation. Commodity markets do not move this aggressively without a structural trigger. When silver accelerates this fast, it's not reacting to news headlines or speculative excitement. It's reacting to failure, specifically the failure of a downside trap. In the sessions leading into this move, price was deliberately pushed lower into a zone designed to trigger liquidations. Stops were clustered beneath key levels, leverage was exposed, weak hands were pressured out of their positions with precision. On the surface, it looked bearish. Underneath, it was a setup. Because the moment that selling pressure was exhausted, the market didn't drift sideways. It didn't stabilize, it surged. That kind of response reveals something critical about market structure. It tells you there was deep demand waiting just below the surface. Not emotional buyers chasing momentum, not short-term traders, but patient capital that waits for forced selling and steps in only when liquidity appears. Once those buy orders were filled, available supply vanished. And when supply disappears in a leveraged market, price doesn't move gradually, it gaps higher. That surge carried silver through one of the most important psychological thresholds in the market, the $80 level. This is not just a round number, it's a line where risk models change, where short exposure becomes dangerous and where positioning must be reassessed in real time. Breaking through that zone with speed alters the entire dynamic. Because when price moves aggressively against concentrated short positions, it creates a mechanical chain reaction. Losses expand, risk limits are breached, positions must be reduced. And reducing a short position means buying the asset back at increasingly higher prices. That buying pushes price higher still, forcing the next wave of shorts to react. It's not panic, it's math. A self-reinforcing loop where forced buying becomes the fuel, but silver is not acting alone. To understand why this move carries so much weight, you have to look at the leader of the precious metals complex. Gold has been advancing steadily into historic territory. Gold doesn't move on industrial headlines. It moves when confidence in the system erodes. When gold climbs methodically while silver accelerates violently, you're watching silver's leverage reassert itself. Silver is not just an industrial input. It's a hybrid asset, part commodity, part monetary metal. And when monetary stress enters the equation, silver doesn't walk, it runs. That's when the gold to silver relationship begins to compress. Silver starts moving faster than gold as it attempts to close the valuation gap. This isn't speculation, it's repricing. At the same time, discipline matters. Markets do not move in straight lines. Powerful upside sessions often bring volatility. Pullbacks are normal. Retests are expected. Short-term turbulence does not invalidate a longer-term structural shift. Technically, what we've seen is decisive. Recent buying didn't just absorb prior selling, it completely overwhelmed it. Control shifted, momentum flipped, the move lower failed, the trap closed. But it didn't catch the bulls, it caught the shorts. And yet, the most important part of this story isn't visible on a single Western trading screen. It exists in the growing tension between markets that no longer agree on what silver is worth. For months, pricing in the East reflected physical scarcity while Western markets continued to trade abundance. That disconnect created an imbalance that could not persist. When those gaps close, they don't close gently, they close through force. As Western prices moved higher, the question became unavoidable. Is the premium collapsing in the East, or is the West being forced to reprice reality? That distinction matters far beyond traders. Because once price begins moving this fast, the impact spreads beyond financial markets and into the real economy. For a trader, a sharp move is opportunity. For a global manufacturer, it's disruption. If you operate on just-in-time supply chains, whether in energy, electronics, or advanced manufacturing, you don't speculate on raw materials. You secure them. Delaying a purchase might seem rational in a cooling market, but when price reverses violently, hesitation becomes a liability. At that point, buying is no longer optional. It becomes mandatory. That shift from discretionary demand to forced demand is where volatility turns into panic. And it's exactly the kind of environment that exposes fragility in supply-constrained markets like silver. This is the difference between an investor choosing to participate and an industry being forced to comply. And this move has only begun to reveal what's underneath. A factory doesn't have that flexibility. And that difference between choice and necessity is what opens the arbitrage window we have been tracking. For an extended period, silver pricing diverged across regions. Western markets reflected abundance, while Eastern markets priced scarcity. The spread widened far beyond what a physical commodity can tolerate. That imbalance wasn't theoretical, it was mechanical. When the same metal trades at meaningfully different prices in two connected markets, it creates a flow problem. Metal doesn't stay where it's cheaper, it drains toward where it's valued more highly. And to stop that drain, the lower price must rise. That's not opinion, that's physics. What's important here is how that gap began to close. It didn't close because prices in the East collapsed. It closed because Western prices were forced to adjust upward. That distinction matters. The paper market didn't lead this move, it followed it. Reluctantly, under pressure, the repricing wasn't orderly, it was reactive. Western markets were forced to acknowledge a physical reality that had already been established elsewhere. And once that process starts, it doesn't stop cleanly, because volatility introduces a second-order effect that almost no one talks about, the seller strike. When price accelerates violently, physical supply doesn't increase, it disappears. If you hold physical silver and price is moving aggressively higher, the incentive to sell vanishes. Scrap dealers pause. Refiners slow their flow. Mines hesitate to forward sell. Everyone waits, not because they're greedy, but because uncertainty favors holding over releasing inventory. At the exact moment demand intensifies, supply pulls back. That creates a liquidity vacuum. Buyers are desperate to secure metal at current prices, while sellers are waiting for higher ones. The bid-ask spread widens. Slippage increases. Price action becomes erratic and sharp. This is not efficient market behavior. It's the opposite. In a textbook market, rising prices attract supply. In a squeeze, rising prices remove supply. That inversion is critical. It's the same behavioral pattern seen in currency crises and commodity shortages. As confidence in price stability erodes, the asset begins to behave less like a commodity and more like a store of value. The higher it moves, the more tightly it's held. But caution matters here. Rapid advances are rarely smooth. Parabolic moves invite volatility. It's entirely possible that paper markets attempt to retest key levels, probing for weakness, searching for sellers. Support will be challenged. Price will be tested. What matters is not the noise, but the floor. That floor is rising. Industrial consumers can no longer plan for dramatically lower input costs. The expectation of cheap silver has disappeared. Procurement strategies are being forced upward. What used to be optional buying has become defensive buying. And as the floor rises, the ceiling becomes unstable. This brings us to the larger implication, the one that sits beyond manufacturing and arbitrage. Silver isn't moving aggressively because of a single industry. It's moving because stress is spreading through the financial system. To understand that, you have to zoom out. Silver gaining sharply is important. Gold pressing into historic territory is something else entirely. Gold sits at the top of the monetary hierarchy. It is the reserve asset of central banks. It doesn't respond to production cycles or technological demand. It responds to confidence. Specifically, confidence in sovereign debt and fiat currency. When gold advances decisively, it's not speculating. It's signaling. A sustained move in gold reflects discomfort with the stability of the debt system itself. It's a vote of no confidence, not in growth, but in control. And that's why silver's response is so violent. Silver occupies a unique position. It straddles two worlds, 1 foot in industry, 1 foot in money. When industrial demand tightens, silver rises. When monetary stress enters the picture, silver accelerates. Right now, both forces are acting at the same time. For years, silver was treated as just another industrial input, like copper, like zinc. Useful, but replaceable. That perception suppressed its monetary premium. That premium is returning because silver remains accessible in a way gold is not. It carries the same monetary characteristics, scarcity, durability, neutrality, at a price point that allows broad participation. And when momentum appears, retail capital reacts emotionally. Retail doesn't analyze structure. It chases performance. When large daily moves appear on screens, attention floods in. Buying follows. And that buying interacts with a market structure that is deeply leveraged on paper. For every ounce of physical silver stored, there are multiples of synthetic exposure layered on top. That structure functions smoothly when prices are calm. But when price moves aggressively, the math breaks. Exposure expands, risk increases, losses compound. At that point, buying is no longer a strategy. It's damage control. Those who sold synthetic exposure must hedge it. Futures are bought not because conviction changed, but because losses demand containment. This is forced activity, not discretionary positioning. And forced activity is always destabilizing, because it feeds volatility instead of absorbing it. This is where the derivatives system begins to strain, and where silver stops behaving like a simple commodity and starts acting like a signal. This is what a derivatives break actually looks like. When leverage embedded in the system begins to unwind, the paper structure stops behaving like a price discovery mechanism and starts behaving like a shock amplifier. Spot prices no longer move smoothly. They disconnect, they gap, they overshoot. We've seen this before. When leverage overwhelms liquidity, exchanges struggle to keep up. Volatility expands faster than risk models can adjust. Bid-ask spreads widen. The paper market strains under pressure from the physical market beneath it. Early warning signs always look the same, and silver is beginning to display them. Which brings us back to the safe haven question. Why does capital seek refuge at moments like this? Because when inflation erodes purchasing power and bond yields fail to compensate for it, holding debt becomes a guaranteed loss. You don't need a crisis headline for that shift to happen. The math alone is enough. Capital looks for protection, for something that can't be diluted, printed, or restructured. Gold has always been that destination. It's the primary reserve asset, the ultimate store of confidence. But access matters. And when participation in gold becomes constrained by price, capital looks for the next available shelter. Gold is the main residence, silver is the overflow, and that flow isn't about speculation, it's about preservation. An ounce of silver maintains purchasing power across time in a way currency cannot. Cash quietly loses value, the metal holds. That quiet contrast is what drives long-term capital movement. Now the focus turns to the road ahead. Breaking above a major psychological level doesn't answer every question, it creates new ones. Markets entering open territory often experience turbulence. When price moves rapidly, margin requirements tighten. Risk managers react. Volatility is not a side effect, it's the mechanism. The destination may be clear, but the path will not be smooth. We've examined the failed trap. We've traced the supply shock. We've connected the monetary signal. Now comes the forward-looking question. Where does this repricing process lead? Viewed through the lens of relative valuation, the move so far is not extreme. The gold-to-silver relationship remains historically stretched. Even after recent gains, silver still trades at a ratio that suggests imbalance, not excess. In prior cycles, when monetary stress peaked and participation widened, that ratio compressed dramatically. Those were moments of acceleration, not exhaustion. If price discovery continues, the market enters a zone with limited historical reference. Momentum becomes self-reinforcing. Attention expands. Media coverage follows. Retail participation increases. That wave doesn't start the move, it fuels it. Institutions, however, are rarely caught off guard. They position early, they anticipate volatility, and when price becomes unstable, they test conviction. Sudden drops, sharp reversals, fast recoveries. These moves are not random. They are designed to challenge patience. Large daily swings will feel uncomfortable. They will feel intentional. And in many cases, they are. The goal of volatility is not to change the trend. It's to remove participants. That's why surviving this phase requires filtering noise from signal. The signal remains physical. Is scarcity resolving? Is industrial demand easing? Is monetary pressure reversing? As long as those answers remain unchanged, the broader direction remains intact. What's unfolding is not a short-term anomaly. It's a repricing of a strategic asset. Silver is moving away from being treated purely as an industrial input and back toward its role as monetary metal. The market is being forced to confront a simple reality. There is not enough physical supply to comfortably support the volume of paper claims layered above it. As leverage unwinds, price must rise to ration demand. That's not ideology, that's structure. Which is why physical ownership matters. Paper exposure introduces counterparty risk precisely when stability disappears. Cash settlement is not neutrality, it's admission. It signals that the underlying asset was unavailable when it mattered most. In moments of stress, possession becomes the differentiator. The move above major levels doesn't mark an ending. It marks validation. The trap failed. The unwind is underway. And the window that existed for comfortable positioning is narrowing. This isn't a moment to blink.